Am I here with money I cannot afford to lose? Understanding risk tolerance and emotional exposure in investing. A crucial question every investor should ask before committing capital is, am I investing money that I truly cannot afford to lose? This question goes beyond strategy or market analysis. It examines emotional tolerance, personal circumstances, and the psychological impact of potential losses. Behavioral research and behavioral finance emphasizes that emotional exposure often determines financial decision-making as much as logic does. 1. The danger of investing essential money. Investing funds that are critical for living expenses, debt repayment, or essential life goals can create heightened stress and lead to poor decision-making. When the stakes feel too high, the brain prioritizes loss avoidance over rational analysis. Emotional reactions dominate judgment. Impulsive decisions are more likely. This ties into the concept of loss aversion, first studied by Daniel Kahneman and Amos Tversky. Loss aversion is especially strong when money is perceived as essential, amplifying fear and stress. 2. Emotional costs of overexposure. Using money that cannot be risked introduces psychological strain, which can manifest as sleepless nights, obsessive checking of portfolio performance, overreacting to market volatility, abandoning long-term plans under pressure. This aligns with research on myopic loss aversion, studied by Richard Thaler and Shlomo Benartzi. Excessive emotional exposure often results in decisions that undermine long-term returns, even if the investment is technically sound. 3. Risk tolerance and investment alignment. Financial advisors emphasize that an investor's portfolio should align with their risk tolerance and personal situation. Key principles include: only use disposable or non-essential funds for high-risk investments. Match asset allocation to comfort with volatility. Recognize that emotional stress reduces the ability to act rationally. Investors who ignore these principles may find that even small losses feel catastrophic, forcing them to exit positions prematurely. 4. A practical self-check. Before making an investment, pause and ask, would I sleep well if this money decreased by 50% tomorrow? Am I financially dependent on this money for daily life or obligations? Am I investing with a clear plan, or am I pressured by circumstances? If the answer suggests that losses would be intolerable, it may indicate overexposure and misalignment with risk tolerance. 5. The strategic perspective. Investing should balance growth potential with emotional sustainability. Using only money that one can afford to lose protects mental health, allows decisions based on strategy rather than fear, increases long-term resilience, ensures patience during market fluctuations. Final insight. Markets reward rationality and discipline. Investing money you cannot afford to lose compromises both. Before entering any position, ask, am I here with money I cannot afford to lose? If the answer is yes, the smartest move may be to adjust exposure, scale down, or wait, because emotional readiness is as important as financial potential.